Your market news now. U.S. markets were closed yesterday due to the Martin Luther King holiday, but U.S. futures indicate that the three main indexes are likely to fall when markets resume trading. Meanwhile, European shares opened lower as investors reined in expectations of interest rate cuts following recent comments from ECB officials. The earnings season is currently underway in the United States and Europe, with investors assessing the impact of high interest rates on earnings. To give us a little bit more perspective on the market dynamics, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. You look at the JSE right now, we read across the board. So what's driving that negative sentiment?
I think, as you said in our intro, I think markets were a little bit ahead of themselves with the expectations when it comes to interest rate cuts. And as now we start getting some comments, showing that maybe we might not be getting anything, not just necessarily for the first quarter of this year, but probably even for the rest of this year, then those kind of news, they make markets or any risky assets to look bad, and people are running away from those kind of assets. So any debate that seems to be pushing this whole idea that we might be getting interest rate cuts anytime this first quarter or second quarter tends to be very negative for the markets.
With that said, then let's unpack your base case for the first half of this year and how that plays into any kind of rate cuts.
We'll continue to watch data, but we have to be very careful, and maybe this is something we have to unlearn as market participants, that we don't have to make a conclusion coming from one set of data. It has to be something continuous, something sustainable. So we need to start monitoring data much better, not just to be carried away by one good set of data. Then as it stands now, and the comments that we've been getting from most central bankers, including the likes of the US, that it may also be reluctant to cut in the first quarter, then chances are markets will reprice their expectations when it comes to interest rate cuts for the first two quarters of this year. And maybe if all goes well with inflation, as we see that is continuing to go down, now the issue will continue to be what is going to be happening with the labor market, and bearing in mind that most central bankers have indicated that, yes, there is a possibility of a recession. They're not ruling that out, but the guys are still prepared to go ahead to tame inflation. So inflation coming down, and if it continues to do that, then yes, one can expect that maybe the second half of this year, one can start expecting some rate cuts, but not in a rapid way.
Are you positioning for any gray swan or black swan events?
We love to, but as you are saying, black swan, we don't even know when it will happen and how will it happen. But I think in all fairness, if you've got something more diversified, and diversified, we're not just talking about sectors, we're talking about having things that can, in other instances, move against the market, meaning they have a negative correlation with the markets. Probably that might help, but it's a very difficult thing to do.
Let's talk locally. Yesterday, I was talking to an analyst about Sasol, and I want to get your view on it because last week, Wednesday, we saw a sell-off in that share price, and that was triggered by an earnings downgrade from JP Morgan. Your view on Sasol and some of the concerns surrounding that share?
We know that the likes of Sasol are making their money coming out of the oil prices and chemical prices, and both those commodities, they'll only be in demand when the world economy start doing okay. So far, we've seen that world economies are, or most market participants have priced in more of a soft landing, meaning you don't expect some huge demand coming from the likes of chemical users and also petrol users, and that will probably affect the prices thereof. So yes, one will continue to be neutral on it. But if things tend to be okay, and given the numbers that we're expecting tomorrow from the Chinese GDP, if we see that they continue to do very well, then most probably that might help the likes of chemical prices going forward. And also not forgetting that whole effect when it comes to the killings or the bombing when it comes to the Red Sea, that can also have a negative impact when it comes to the supply chain thereof.
Is Sasol a share you'd be happy to hold?
Definitely.
Okay, so let's move things on and talk about U.S. earnings season. What do you believe will be the main theme as these earnings start to roll out?
If you look into the banks themselves, we have seen so far they've been giving some mixed set of results. But the most important thing here is, like the ones that we'll be announcing today, we expect to see when it comes to the investment banking that things continue not to be that great because of geopolitical tensions, because of high inflation, high interest rates. So we don't expect much activity out of that side. But when it comes to the trading side of things, probably guys have made good money because markets have been very volatile, and in a very, very volatile market, then you get more trades gets to be done. And so far, the US consumer seems to be very resilient, and hence you get comments that when you compare it globally, apparently the US economy looks much better compared to other economies. Hence, the demand for their assets continue to rise. So we expect them to also be doing just okay. Yes, they will continue to struggle to reduce expenses, and also their revenues, you expect that just to grow a little bit, not too much.
Let's stay stateside and look at the big 7 tech companies. They were responsible for the majority of the S&P 500's gains last year. Your view on them for 2024?
They continue to be priced for perfection, and we just hope that everything continues to be right for them, because any slight mistake, then we would see a very serious sell-off. People don't expect some disappointment coming out of that, but we have to continue to monitor the developments when it comes to the semiconductor industry, because that can have a negative effect.
Do you believe stocks can rally beyond those big 7 tech stocks?
Definitely, they still have some legs to run on. But now the thing is, as we mentioned, the semiconductor industry is very critical to watch, and also whether this whole issue between Israel and Hamas will continue to be localized or not.
Before I let you go, once the Fed does start cutting rates, what does that mean for stock markets? Can they continue rallying?
Definitely, one, it makes it cheaper for companies to repay whatever debt they have. Number two, it makes it cheaper for consumers to be able to have some extra money, as we know that they'll be paying less or whatever that they'll be owing. And we know that most developed economies, more than 60% of the economies are driven by consumer demand. So any relief that we will be seeing on consumers, we expect that to fit into the main economy. And the stock market in the real sense is supposed to be forward-looking, so one will expect the stock market to do better.
Makwe, thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers. And as he mentioned earlier, we're going to be paying attention to tomorrow's GDP numbers for the fourth quarter coming out of China, likely to affect sentiment in the short term. So we're paying attention to how commodity markets react, also how our local resources and industrial shares react to those figures.